Hey everyone, I'm Professor Stefan, and in this video we are going to start inventory. Now inventory is definitely one of the harder topics we cover. There is a whole lot of information in here. We're going to spend 3 days on it, so we're going to try to take our time, make sure we understand the intuition behind it, and that will help us when we get to the problems that we need to solve. So let's get started. So our goal for this video is to define what inventory is and think about what costs are included in inventory and when is inventory on our books versus when is it on maybe our customers' books or our suppliers' books. So inventory is defined as tangible goods that are held for sale. So these are the goods that you sell to your customers to generate revenues. Now, whether a tangible good is inventory or not does not depend on kind of what type of tangible good it is, but rather how does the company use that good. And so you can imagine computers for a company like McDonald's, right? McDonald's sells, hamburgers and cheeseburgers and chicken nuggets and all that tasty stuff. Computers that McDonald's uses are generally considered PP&E, right? These are long-term assets. But if you are Dell and you sell computers to your customers and that's your business, then computers would be considered inventory on Dell's side. So it really depends on how a company is using a good versus just what the good is itself. Now, inventory is going to affect our balance sheet and our income statement. On our balance sheet, inventory is listed usually as one of those current assets, the items held for sale. And on the income statement, inventory affects that by flowing into cost of goods sold. So when we sell our inventory, it turns into an expense, and that is the cost of whatever we are selling. So an example here from Brown-Forman, you may have partaken in some of their tasty beverages such as Jack Daniel's or Finlandia vodka, but we can see from their footnote disclosure that inventory includes more than just their finished bottles of liquor that are, held for sale. It includes the raw materials and supplies that they're going to process into those finished goods, and it includes kind of work in process or WIP, which are the items that are still kind of being made. And so that could include things like barreled whiskey when it has to age for a while before it can be sold. So it includes stuff before it's ready for sale as well as the finished goods that they are waiting to sell. And this about $1.3 billion, the final number, kind of the sum of all of them, is what's going to be presented on Brown-Forman's balance sheet. All right, so like I said at the start, inventory is definitely one of our harder topics, and we're faced with 4 distinct challenges that we're going to have to deal with. So we're going to have to answer what goods are included in our inventory, what costs get included in our inventory balance, which items did we sell when we make a sell, which costs do we choose to go into cost of goods sold, and finally, what if the value of our inventory changes over time? So starting with our first question, well, what goods get included in our inventory balance? Most obviously we have the goods that we actually have in our physical possession, right? But there's a little bit of a gray area when we have goods in transit. And so we could have goods coming to us from a supplier that we purchased from somebody, and maybe they're, sitting on the ocean or sitting on a truck somewhere. Or we could have goods that we have shipped to a customer that are sitting on the ocean or sitting on a truck. And so we have to figure out which of those goods in transit show up on our balance sheets and which of those goods in transit show up on either our suppliers or our customers' balance sheets. And to answer this question, we need to know the contract terms with our supplier or customer. And there's kind of a new vocabulary we need to learn. I'm not sure if you guys heard this in the mod or not, but there's something called FOB, which means free on board. And then there's kind of 2 terms that go with that. There's shipping and there's destination. And if it is FOB or free on board shipping point, then the title to the goods transfers whenever the goods get shipped. So whenever they leave the shipping dock, the title transfers over. And so if you're buying goods from a supplier and the terms are FOB shipping point, then when the supplier ships those goods, even if you don't physically have them, if they're, on the boat or on the truck, after they are shipped, those goods are yours and they show up on your inventory. So that's FOB shipping point. Now the opposite is going to be FOB destination. And that's when the title transfers once the goods arrive at the person buying them. And so if I'm buying goods from a supplier and the contract terms say FOB destination, then all of those goods in transit, they're not mine yet. I have to wait until they arrive at my dock to record them in my inventory. And it's going to be the opposite if I'm shipping goods to a customer, right? If it's FOB shipping point, then the title transfers once I ship them, so anything in transit is not mine anymore. If it's FOB destination, then it remains my inventory while it's in shipment until it arrives at my customer. Now, we talked a little bit in revenue recognition about consignment arrangements. And remember what we said is that we have a principal agent, right? And the agent is holding the inventory for the principal and trying to sell it. But the inventory remains the principal's inventory. So in a consignment arrangement, the original owner, the principal, holds the inventory on its balance sheet. The consignee never takes that inventory. So we've dealt with which physical goods get recorded in our inventory when they're in transit or in a consignment arrangement. And our second question then is which costs are included. And generally, we're going to include all of the costs that we have to pay to acquire and prepare our goods for sale. So for a merchandising or retail type firm, these could include the unit price, exactly what we pay. They could include freight charges that we have to pay to have it shipped to us. It could include packaging and handling costs by some of our employees. We might reduce it by any discounts that we receive. So if we buy a big volume of things and we get 10% off, well, that reduces the amount we pay by 10% and it reduces our inventory value by 10%. So we're looking at what do we actually pay for these goods, and we include kind of the incidental costs to acquire and get these things ready for sale. Now, if we're a manufacturing firm, things get a little bit more complicated because we're going to have raw materials that go into our goods. We're going to have direct labor costs, right, that we have to pay in order to produce these goods. And we're going to have all sorts of different types of overhead, like supervisor salaries. We could have depreciation on the plant where it's being manufactured. We could have, maintenance people. We could have electricity costs to, run the machines that are producing our inventory. So there's all sorts of associated overhead that is also going to go into our inventory value. So anything used to produce that inventory goes into that value on our balance sheet. Now, overhead that is not tied to production. So things like accountants' salaries or, the salaries or commissions of the salespeople or the depreciation on the headquarters building or something like that. That does not go into our inventory costs. So we're only looking for the costs that directly relate to the production of inventory. So to illustrate this a little bit, we're going to look at the same types of costs and see when do they apply to inventory and when are they period costs or that kind of SG&A type stuff that goes outside of cost of goods sold. So let's say we're paying our employees, the accountants, the salespeople, the people that work in our headquarters, the admin people. All of their wages are going to get expensed as incurred. So as we pay these things, we'll credit cash or credit salaries payable, and we debit the expense immediately. Now, if these wages are related to the production of inventory, we're still going to credit our cash or credit our salaries payable. But instead of debiting an expense, we're actually going to debit our inventory asset. So we're going to capitalize these wage costs because they are related to the production of inventory. And these wage costs are not expensed until the inventory is sold and it turns into our cost of goods sold. We see the same thing with utilities. If it is a utilities cost for, say, our firm headquarters that does kind of, general and administrative type stuff, it gets expensed as incurred as a utilities expense. If there are utilities costs related to our manufacturing plant where we make our inventory, we debit our inventory asset again. So we are capitalizing these costs into inventory because the utilities are related to the production of inventory. And finally, same thing with depreciation. Depreciation on our firm headquarters gets expensed as incurred. Depreciation on our manufacturing plant or the machines in that plant, that gets capitalized into inventory. And so it becomes an asset on our balance sheet until we sell it, and then it gets expensed as cost of goods sold. And so what you can see is that when we have cost of goods sold for a manufacturing firm, it actually includes all sorts of different types of expenses. It is not just raw materials, but it's direct labor, it's overhead, it's utilities, it's depreciation. It includes everything related to the production of that inventory. So in the next couple classes, we're going to talk about our final two questions of what items did we sell. That is a much more complicated question to answer than you might imagine. And we're going to talk about what happens if the value of our inventory changes. What if we have a product in our warehouse and suddenly nobody wants to buy that thing anymore? What do we do in that case? So to summarize here, inventory are our goods held for sale, and it includes both raw materials and work in process. We have to be aware of goods in transit. Are they our goods on our inventory books, or are they our customers or our supplier goods? And so we have to look at that, whether it is FOB shipping point, where title transfers once it's shipped, or is it FOB destination, where title waits to transfer until it arrives at whoever is buying those goods. And finally, when we're manufacturing inventory, or even when we're buying it on the retail side, we include all the costs to acquire and produce that inventory. And so we need to think about, was this cost related to the production of inventory, in which case it gets capitalized, or was this cost not related to production, in which case we expense it as incurred? Thanks for watching.